But this woman is making sure that this particular robot is.
I like you. Who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is Ellie Q. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello.
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is Ellie Q.
Can I take her out for a spin?
Please.
Ellie Q, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month. How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. she should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ,
Yes,
schedule a doctor's appointment.
no problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard, no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can't say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousey things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly the print was, I could see that
Okay.
quite clearly.
What about this?
I can see that. LEQ, Play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence, robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. It seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are going to seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. One, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game, the best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera, like in any sort of performance thing.
Exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera, like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Yep, it is Monday, May 8th, 2023. You know Tim is on leave, and whoa, leave the door open, and guess who comes walking in? Matt Miller. It's like deja vu all over again.
It is great to be here on Street Smart. I've waited so long for this.
We did do Street Smart, and then we did something in the morning. Remember you, me, Julie, way back when?
Way back in the day.
Oh my
Brian
gosh.
Sullivan,
Adam Johnson, Dom Chu.
There were a lot of us. Anyway, yeah,
Right.
I'm here and I'm excited. There's a lot going on today, and I
Yeah.
hope we can cover it all in the next 3 hours.
I feel like there was kind of a trading day, at least on the equity side of things, but we do have a lot of things, including that pickup in corporate issuance. We're going to take a look at Apple. You were just looking at the story just crossed, actually selling more.
So
in
many
its
people
corporate bond
wanted
offering.
Apple bonds
Who
that
doesn't?
instead of $5 billion, they're going to sell $5.25 billion, and instead of having to pay 135 over Treasuries, they're going to pay 108 over Treasuries. So they're getting a good deal for it as well.
I wonder if Warren was buying. Well, the reason I ask is he kind of loves Apple.
He
He's all
absolutely
in.
does. You know, he said at the meeting this weekend, Berkshire Hathaway had their shareholders meeting over the weekend, that he thinks Apple is run better than any of the company he owns.
Wow.
I think that's kind of a little bit of shade thrown at his own managers, don't you think?
That's really rough. I mean, he owns a ton of different companies. He's just, I guess, I don't know how you, yeah, that's a little rough. Anyway, we're going to talk about Berkshire's annual meeting. Also on our radar again, regional banks. 2 reports with clues on the health of the industry. One's already out. One's to come after the close. We're going to get into that. And then, Matt, we're going to talk a little bit about the battle in the skies. I love it when Airbus and Boeing go at it.
Yeah, me too. I mean, it's a duopoly, so nobody else can sort of come in to this competition. But Airbus, you know, I have always been a Boeing fan. I don't know if it's because I'm American. Airbus has planes that I flew a lot in Europe, and I didn't like them. Not a lot of leg room and very squished, I felt.
Little shade to Airbus. We're also going to talk about construction. We've got the CEO at McKissick. They've been around for more than a century, so we're going to talk about a great indicator of the economy. Right now, though, we're talking markets because Bloomberg's countdown to the close. We're heading over to TV. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic, Scarlet Fu, joined right now by our colleagues Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio, Originals, and those folks streaming on YouTube. Happy Monday, Carol. I haven't seen you in a few days.
You came back. We were so convinced you were.
Yeah, you came
doing a
back
film
fast. I
deal.
stayed out there and continued working, but that's okay, Carol. We talk about what this market is doing, which is relatively nothing.
No.
But underpinning that is a big reason why nothing is really happening.
Yeah, that's fair to say. I feel like you dig deeper into the trade today, and there's a lot of things. We're going to talk about maybe this corporate bond offering by Apple and others to come, certainly this week. But I've been looking at the regional banks again. There's a lot of activity, and we're going to bring up some numbers for you. We had already the senior loan survey come out showing tighter credit, weaker business loan demand. Take a look, though, at the regional banks as a group overall, just down about 1%. But some other names, like a PacWest, coming out saying its business remains sound. It's cutting its quarterly dividend to a penny to accelerate capital build plans. That one rallying up more than 6%. Western Alliance is up more than 3%. And Matt Zion's also up more than 4%. So despite the index a little bit lower, some individual names, yeah.
Yeah, I'm watching those regional banks as well. Actually, we spoke with Bill Gross earlier. You know, he bought them a couple of weeks ago, maybe too soon. But he does think that you need to own banks right now to play in the recovery if and when it comes. I'm also looking at Tyson Foods, their biggest drop since 2008 in the market today because they're facing challenging markets in all of their sectors, beef, pork, and chicken. There's nothing for Americans to switch down to. There's no cheaper meat out there. So Tyson really getting hit hard today. On the flip side, Carnival Cruises is doing very well. In fact, all of the cruise lines are doing very well. But I noticed that Carnival is up almost as much as Apple year to date, like 31%.
All right, let's get a broader check on the markets right now. A little bit of stasis here. Range-bound market for the S&P, relatively unchanged, up about 0.1%. Flip that up, and you get a Dow Jones down about 0.1%. And similar flip-flop for the NASDAQ and the Russell. The NASDAQ up about 0.2%. The Russell in the red.
And a pretty mixed read when you look at the industry groups in the S&P 500 as well. 11 groups, 5 are in the green, led by communication services, and specifically the streamers like Netflix and Warner Brothers Discovery. And of course, financials, as Carol was showing us earlier, Zion's is the big gainer there. On the downside, REITs are falling about 0.75%. Healthcare also a loser here because of Catalent, and utilities losing about 0.3% as well.
All right, let's get you some individual movers here. Carol, you were mentioning Apple coming to market here with a pretty big debt sale in 5 parts here, $5 billion, and more importantly, basically a recommitment here to continue those share buybacks. Shares only up fractionally here on the day. The big star of the day, though, that belongs to Zscaler. They came out with preliminary results. Those shares rallying by about 21%, biggest day that they've had at least in about a year here, and that's actually lifting a lot of other big cyber security stocks as well. To the downside, you mentioned Tyson Foods down about 17%. And Occidental Petroleum down about 2%, largely on the back of some comments made by Warren Buffett and his team that basically the big stake that they've been taken in Occidental is just that, a stake, and they have no intention of making that 100% in full. Some of the optimism and the rally that we had seen in Oxy over the past few months have been tied to that speculation about what Buffett and Berkshire could potentially be doing. We do want to go back to some of the broader data in the banking sector, particularly with the latest senior loan officer survey out of the Fed. Now, the good news is that lending as a whole was only sort of marginally impacted. It actually held up pretty well. The bad news is that when it comes to the difference between what banks are saying they're willing to do and, more importantly, what borrowers are saying that they want to do, that's where the bad news is. Demand for those loans absolutely cratering here, and that's going to be a big part of the story going forward, particularly when it comes to the recession narrative.
Yeah, absolutely. A great indicator in terms of economic health or lack thereof out there. So Bill Gross talking about that. We're going to also talk a little bit about Matt and Katie's conversation where he got into a bunch of different things, including his read on inflation. It's really timely considering we get the CPI and PPI print. Here's what Bill Gross, co-founder of PIMCO, said to Matt and Katie earlier on Bloomberg TV.
I don't think there's much of a chance to get back to 2% absent a severe deflation, which I don't see at the moment. I think policymakers come to the rescue. But it's a 3 to 4% environment going forward for me.
And of course, that's Bill Gross, co-founder of PIMCO, talking earlier with Matt and Katie on Bloomberg TV. But I feel like there's a little bit of momentum out there increasingly from, I know, folks that we talk to, that this idea of going back to 2%, I don't know, Matt, you had the conversation. I don't know what else he said along those lines, but it just doesn't make sense considering the environment we've had.
Exactly. Well, or considering, over the last 50 years, inflation has averaged 4%. It hasn't really been 2%, with the exception of a brief period where we were doing anything we could to try and jack it up higher. So it's going to be more difficult. It's more sticky, right? Even after you saw that goods inflation come back down, you're still having services inflation at a relatively high level. And with wages rising 5.5% every single month when we get those non-farm payrolls, it's a long way off.
Right. So the question is, how does the Fed respond to all of this? And increasingly, you're seeing firms now betting against the prospect of Fed rate cuts later this year. Goldman Sachs, Barclays, among them, joining hedge funds in positioning against that eventuality, at least for this year.
That's right. And I'm curious here, Matt. I mean, when you talk about what Gross said, I mean, it's a good point when we talk about sort of what that longer-term historical baseline is. And, of course, I mean, we can talk about how we ended up at 2% anyway. I guess you can blame some New Zealand economists for that. But the idea here that maybe the rethink, if not by the Fed, certainly by the markets, has already kind of been afoot.
Yeah, I mean, I'm surprised that the market was betting on rate cuts this year to begin with, because every time Jerome Powell comes out, he tells us that they're not going to be any this year.
Have you always worn glasses, or what's happening here?
You know what? I wear reading glasses. So these are progressives, but since I'm here in the radio studio.
Anytime I see you, you're always just like in a Hawaiian shirt.
You know what the amazing thing was for me, Romaine? Bill Gross told us 30% of his portfolios is in MLPs. 30%.
Really? Okay. Well,
that's a big chunk.
Yeah, that is a big chunk. He's known for making bold moves, isn't he?
He is. And so I was interested to hear that that's his move today. Otherwise, he says he likes to buy tips because he doesn't think inflation's coming down. He likes to buy commodities because he doesn't think inflation is coming down. And he likes short-term treasuries in the form of ETFs, specifically STIP and VTIP.
Yeah. I mean, listen, this debate about where we go back to, I think most of us agree that some of the conversations we've had, that things have changed dramatically. And this idea of getting back to that 2%, as you say, Romaine, where did it come from, right? And what does it mean? I guess time will tell.
It's always been kind of arbitrary, right? I mean, and so the question is, if the Fed says, 3% is close enough, then that becomes a moving target, and then everything it says is under question and under scrutiny as a result.
But Jay Powell hasn't yet. He's sticking to his guns, which is kind of interesting. All right, it's a Monday. It feels like a Monday, but we're going to be back in less than an hour.
I love Monday. A whole week is ahead of us.
What is wrong with you? Matt loves Mondays, guys. All right, we'll be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. Join us at 4 p.m. Wall Street time.
We get
everybody. You are listening and watching Bloomberg Business Week. Carol Massar along with Matt Miller, Tim on leave. We're live in our Bloomberg Interactive Broker studio on YouTube on Bloomberg Originals. Now, Matt was kind of hot and heavy about doing the Apple debt offering.
I mean, to me, it's huge because this company, already has $170 billion in cash.
What does it need money for?
Right? They don't seem to need money, although if I type in DDIS on the terminal, I can see that they have $44 billion in debt coming due over the next 4 years.
So it's all about maybe just managing that debt, right? The next round. Let's see what Robert Schiffman has to say. He's senior credit analyst at Bloomberg Intelligence. He's here in our Interactive Broker studio. That's right. I mean, we've all been reading your work that says they've got a fortress balance sheet, right? So why do they have to do this? Or is this just business as usual for Apple?
Yeah, I sort of don't want to burst everybody's bubble, but this is a little bit of ho-hum. You know, Apple raising $5.25 billion, it's almost a rounding error. And, you know, if you look, you taled about how much debt
for
is
Apple.
For
right?
Apple,
Not for
of course.
us.
Yes, no, I live in a different world of mega cap. You know, over the last 3 years, Apple's raised $40 billion of debt. This is sort of just regular course of business for them. Like I said to you earlier, Matt, like I'm wondering why they're just not raising a little bit more. You know, maybe it's a play on rates. Maybe they think that 3 minutes from now, 3 months from now, 3 years from now, rates are going to be a little bit lower and the cost of capital will be a little bit lower.
That's what I'm wondering, right? Why not wait even a little bit more, or just they have to do this?
It's honestly, it's reasonably, it's 5 tranches, but it's reasonably short duration. You know, the first 4 tranches are 3, 5, 7s, and 10s. So it's really not so much, I think, a play on rates. You know, Apple, if you think about it, over time, with $110 billion of debt, they're going to constantly need to refinance, unless they want to take their debt levels down. And they've had $110 billion of debt for the last decade. So what they're really
AAA rated?
Well, they still have 1 notch to go at S&P.
They're AA plus.
But Moody's did raise them to AAA in December of 2021. So listen, we've always talked about the Mount Rushmore of credit. They're on it. They're there with Microsoft.
Well, this is why I wanted to do this story. This is why I'm so hot and heavy on it, because Apple is putting another product out into the market that everybody has to have, right? Everybody wants these bonds. If you can get 5% on 30-year debt in a completely risk-free company, which this is as close as, damn it, to a completely risk-free company, you want that, which is why they got oversubscribed. That's why they did 5.25 instead of 5, and that's why they're got a spread of 108 rather than 135, right?
Yeah, listen, Apple, when you comp them versus their peers, they look pretty cheap.
Yeah.
I mean, they trade wide to both Alphabet and Microsoft. The reason is not so much about credit quality. Like, you're really like mincing words if you're thinking about what's the difference between a AA and a AAA. The real difference is technicals. Apple's got a lot more bonds out there than their peers. So people have a little bit of larger holding. It costs a little bit more to put another 5 or 10 billion in people's pocket. But listen, if Apple wanted to raise $50 billion today, the market would be there for them. It's just a matter of what that cost is.
How much of this, too, is, though, having enough on the balance sheet? I mean, they've got, we said, a lot on the balance sheet, but they like to do buybacks.
Yeah.
They like to do dividends. And if it's a questionable economic environment, potentially, if anything slows down,
We wish they did dividends more, right?
They could still do this and make shareholders happy.
Yeah, listen, they pay a pretty fair dividend. The dividend yield is low, but on an absolute basis, you know, it's $15 billion. It's not like it's nothing. I will tell you, though, was a bit surprised. It's pretty much every year during their fiscal 2Q is when they reauthorize a bigger buyback.
So surprised they did it already?
No, it's surprised that it wasn't bigger. It was $90 billion, which was similar to last year. I think if they really want to make hay on this cash neutral target, you know, they've got $57 billion to get through. You know, why not announce a $125 billion authorization? Listen, I don't know if it's a call on their stock. I don't know.
Maybe they need money for AI.
They don't need money. That's, you know, they have $100 billion of annual free cash flow. I just think it's managing a long-term balance sheet. It looks like what they really want to shake out with is having enough cash on this balance sheet over time that they can do whatever they want. Right now, they can't do whatever they want. For instance, Microsoft is trying to buy Activision, $69 billion cash. Pretty much governments around the world said, no, you can't do it. At some point, maybe there's a different administration. Maybe the M&A environment is different, and Apple can go out there and, I don't know, buy a Netflix. I mean, it seems crazy
or a
nowadays.
Peloton.
Well, Peloton, though, doesn't move the needle. I have my Peloton, and I spin somewhat regularly. It's not moving my weight needle. It's just not big enough. For like these large cap names to do a transaction that actually makes a difference, it's got to be size.
I'm just thinking the whole health and wellness thing, that they are looking, that they see that as a growth avenue going forward.
That's actually a great point that you're making. One of the ways that Apple
Once a month I
can get to a AAA is they need to diversify their revenue stream. And they're doing that. Services had their best quarter ever, but this is still a hardware company. So they need to continue to figure out new, different, better ways to make all of their products sticky. And that means that they're going to have to find things that they're not used to doing.
It's hard to build it. It's hard to get as sticky as the iPhone. I mean, Warren Buffett was pointing out he thinks people in America would rather have an iPhone than a second car.
Yeah.
He said if somebody comes to repo your second car and it comes to giving up your iPhone, you say take the car.
Yeah, I don't think that he's wrong.
One thing I don't get is why the dividend yield is so painfully low. I mean, 0.5%, I get that they spend a lot of money in dividends, but if I buy the shares, I would like a bigger dividend yield as something I can count on and something I can plan on, rather than hoping that they continue, $100 billion of share buybacks every year.
Yeah, well, as a shareholder, you'd also hope that they bought back $1 trillion worth of stock each year. They're doing what's in the long run best financial case for the business. Quite frankly, the dividend also is a little bit ho-hum. Like, why does anyone have a 1% dividend yield? It's to check a box that you're in a variety of dividend funds, so people, so the name fits into various ETFs and indices. I don't think that's going to go up that much. You want to keep your flexibility really high. I think there's a benefit to be able to say, next year, if we want to buy back 150 billion of stock, we can do it. If you triple that dividend, it limits your flexibility over time.
Am I an idiot in always thinking that when you're doing buybacks, it's just financial engineering, right? You're reducing the amount of share, you improve your EPS number. Like, is it just, I know investors like it, I get it. But isn't it a form of financial engineering?
Well, I wish Tom was here, because he would break out Modigliani and Miller, and that theory is that it doesn't make any difference. I will tell you though,
because it doesn't.
Weighted average cost of capital, I think, does matter. Apple's weighted average cost of capital, it's reasonably high. It's because it's got such a large equity component. Their debt component is effectively zero. And that, to me, argues they're supposed to be borrowing a lot more to buy back stock, which has a cost of capital that's closer to 10%.
Are we seeing, though, a drop in the kind of demand that Apple would have previously seen? I mean, are investors out there more risk averse, showing more patience? When you look at the book building for this offering, wasn't it a little bit weaker than you may have expected?
No, I don't think it's being risk averse. I think it's part of being one of the largest non-financial debt issuers in the market. At some point, it doesn't make a difference how big you are on the buy side. You can only have so much exposure to individual names. And, this is Apple's probably most largest individual non-financial exposure out there. So it just gets harder and harder to squeeze in that last dollar. But again, if they wanted to raise another 10 or 15 billion, they could do it. It just might have cost them another 25 beeps across the curve.
Hey, Robert, just broadening out, right? We're obviously focusing on Apple, but there's a lot going on, right, in the corporate issuance world. What are you keeping on your radar this week? And what does it tell you about kind of the economic outlook?
Well, listen, I think
corporate outlook.
We've been saying this for the last couple of years. Is I think that tech needs to be considered the corporate safe haven, and in fact, tech credit needs to be considered the market safe haven. We're seeing right now that banks certainly don't fit that. If you have a super highly rated financial institution with hundreds of billions of dollars of deposits that can go to zero, that's not a safe haven. We've also seen that with treasuries. The volatility that we're seeing, your conversation about what the Fed has been doing and potentially, breaking a debt limit is sort of mind-boggling. So we've always talked about, large tech companies that have massive cash positions that generate tens of billions of dollars of cash a year, that have enormous competitive barriers to entry. Those are the safe havens. People tend to talk about tech as being volatile because stocks are volatile, but tech bonds are not nearly as volatile. They trade tighter than just about every other sector for a good reason. It's because credit risk is really low. So what's happening is we're seeing more companies borrow to buy back shares. We just saw that with Meta.
I was just going to say Meta last week, right? Just quickly, just got about 20 seconds.
Yeah, so I think we're going to see more of this. And if Microsoft's deal with Activision ends up disappearing, I wouldn't be shocked to see $70 billion of buybacks right off the bat. So you're going to see more of this. Tech credits are going to get on the back of their balance sheets, and they're going to benefit shareholders.
I love what you said about looking at the tech debt side of things. Robert Schiffman, Senior Credit Analyst at Bloomberg Intelligence, making us smarter on this Monday. You are listening and watching Bloomberg Business Week. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got 39 minutes to go ahead of the closing bell. We've got the Dow on the minus side, the S&P, NASDAQ. They are both advancing right now. And this update is brought to you by BNY Mellon Insight, June 6th through the 8th in Orlando. Don't miss the essential event for the financial advice community. Visit insight.bnymellon.com. Federal Reserve says banks reported tighter standards and weaker demand for loans in the first quarter, extending a trend that began before recent stresses in the banking sector emerged. S&P right now, little change, higher by 1 point. We have got the Dow lower, down 59 points, dropped there at 0.2%. NASDAQ Composite Index up 16. That is a gain of 0.1%. 10-year yield, 3.51%, with the 2-year now at 3.99%. Spot gold up $5 the ounce to 2021. That is a gain of 0.2%. Crude up 2.2%. West Texas Intermediate, $72.95 a barrel. PacWest Bancorp shares are surging after saying its business remains sound and it is cutting its quarterly dividend to 1 cent to accelerate capital build plans. PacWest shares are up 4.2%. Among some other regional names, Western Alliance up 2.5%. Zions Bancorp up by 3.6%. Recapping, S&P up by 1 point. I'm Charlie Powell. That is a Bloomberg Business Flash.
Thank you very much, Charlie Pellet. Matt Miller here with Carol Massar. I'm filling in for Tim this summer.
You are. Yeah,
can I say this summer? Has it kicked off already?
Not yet. We've got like another month.
It feels like it. I was in the pool this weekend.
June 20th.
Listen, the #1 most read story on the Bloomberg terminal over the last hour. Bill Gross says buy T-bills amid ridiculous debt ceiling issue. He calls it ridiculous because he says it's always resolved and it's basically as close as you can get to 100% chance that it's going to get resolved. I spoke to him earlier today on Bloomberg Television. He said buy short-term treasuries. He said buy commodities. He said ETFs, STIP and VTIP are two that he recommended buying. And I also asked him about the regional banks because he's been buying those. Listen to what he told us.
Well, it's obviously going up and down. The last few days they've bounced back up. The question is whether this is a crisis of interest rates, higher interest rates, or simply a crisis of contagion where investors fear the worst. And those are difficult situations to value and to buy or sell. But I think, based on KRE, which is an ETF and has about 150 different issues, so most of them less than 1% in terms of the weighting. But based upon that, I think we've stabilized to some extent. The values are there. The price-to-book ratios are about 0.6 on average, whereas they used to be on the regionals about 1. And so, we've got a situation where there's value, but we've also got a situation where investors are still leery based upon deposits and the lack of deposits.
And so talk to us why then we're talking about an ETF. Obviously, if you look at the regional bank landscape as a whole, there's been some specific names that have really seen the brunt of the action. PacWest in particular over the past week has been extremely volatile. So if you're looking at this situation evolving, does it make more sense to go into something like KRE that tracks all of these names versus trying to pick one?
Well, I think for the conservative investor, it does. The diversification is a positive, and KRE is not as volatile as some of the ones that you mentioned. That's not what I've done. As a matter of fact, I think buying the stocks or shorting the stocks is really not the way to go from here. I think what you want to do is sell the volatility in this particular sector. The volatility on many of these stocks is extraordinary. On PacWest, it's 300 normalized, which I know is technical, but is extremely high volatility, and it's the same thing on many other stocks. I've been selling volatility on Western Alliance, it's WLAL, and on Zion. Both of those volatilities are much higher than normal, higher than 100. And, should the market simply stabilize, which is what I'm talking about, what I'm thinking at these lower levels, then a 2-week or a month and a half option, what I call a strangle, selling a put, selling a call at 10% above and 10% below, they provide a very, very potentially profitable investment as opposed to simply buying the stock or selling the stock.
All right, so really interesting stuff there. And Bill Gross had been saying he wanted to start his own bank, but when he saw the destruction in the share prices of these regionals, he thought it would just be smarter to buy them himself.
Don't you think it's fascinating, the bond guy buying banks?
Yeah, I do, by the way, and he was a little bit early, right? Because he said he was buying them back on April 21st, and if you recall, last week they got absolutely destroyed.
Yeah.
What I thought was most interesting is that he said he's buying 30% of his portfolio is energy MLPs, master limited partnerships, and I think that's a huge bet to make on MLPs. 30% of your portfolio.
Why do you think it's such a crazy bet, considering the dynamic structurally of what people think in terms of the energy market?
I'm not saying that I think it's crazy that he bet on that. I'm just saying it's a very big bet. 30% of your portfolio is like many of your eggs in the same basket.
Why did he say he's doing it?
He's famous for making these big, bold bets, and this is another Bond King story that he hopes that it is going to play out in his favor. Many of those previously have done so. Who was telling us earlier? He used to get sometimes $250, $260, $275 million on one fund. So that's how much he would get for managing one fund. And of course, at PIMCO, he managed many.
That's some real money.
Yeah.
No, it's really fascinating to see kind of these big bets. I find the energy one, I agree with you. It's a lot of exposure, but I think many would argue that it's going to take a while for us to transition, so why not?
They just got beaten down so hard. We've had Herman Chan on like every day for the past month and a half.
No, we've had him on every day.
Bloomberg, and I meant all of us. When I say we, I mean Bloomberg.
Guess
that
what?
includes you.
Guess what, Matt?
And me.
He's coming up later.
I know, I'm excited, but he was telling us, for example, last week, when we were watching 50, 60% drops, he was saying, these banks like Western Alliance and PacWest, they have enough in assets, even mark-to-market assets, to pay out all depositors if necessary. But we don't see the deposit outflows that should be freaking this market out. So they're just selling off the stock as a shorts attack and not really because of fundamental concerns.
Well, so much of market sentiment, so much of bank sentiment, right? You have to have trust. And if there's nervousness about what the outlook is for these, I mean, he has said the same thing to us. I'll say, well, what's the balance sheet show you? And you're like, they're just fine, right? There's no reason why that they should be seeing the selling that they were seeing. But nonetheless, when you have nervousness within the banking sector, you got to be a little bit worried if you're an investor.
You definitely get nervousness when you see 4 banks collapse in 2 months. I don't know how many banks.
And everybody's saying, okay, this is it. This is it. Oh, no, wait, this is it.
Well, it's pretty terrifying at times. I mean, Credit Suisse as well. We were starting to see a lot of parallels to 2007, 2008. I had COVID at the time, and I was sitting in bed reading Ben Emmons' notes from, New Edge Wealth, and I was like terrified.
I had COVID and I watched Ozark, but go ahead.
It's just that it seemed like we were coming closer and closer to a financial collapse. But you need to put these things into perspective, right? These weren't the biggest banks in the country. Okay, the 16th biggest bank in the country was SVB, but that's not the same thing when you're looking at a First Republic, a PacWest, a Western Alliance, and they have, at least the last two, the assets to cover deposits. So even if everyone took all of his or her money out,
they'd still be fine.
Well, it'd just be like a laundromat collapsing. It's a bummer for those who own the laundromat, but it doesn't ruin the entire financial structure.
The only thing I would say, okay, that's fair enough too, but you do wonder too about the importance and health of these regional banks because they serve a certain part of the sector, the economy.
Very good point.
Middle markets, and that's one of the things we're going to talk about Milken a little bit later on with Eric Schatzker, but being out at Milken again for a second year in a row, the whole idea of the private market stepping in when it comes to lending, and a lot of them are playing in that mid-market space because the big banks, they don't want to do it. We talk about Apple, they can tap the debt markets, they need banking, they can go to a JP Morgan or whomever.
I think that's a really important point, Carol, and we're going to make that with a couple of bets, right? We're going to talk of guests. We're going to talk to McKissick later, and they build, real estate developments, commercial property. Any of those things are, for the most part, funded by regional banks. And when that kind of lending disappears, you don't see J.P. Morgan and Bank of America stepping in to do it, or certainly not at the same kind of prices. So it could cause a real bottleneck in terms of the real estate system in this country.
That's the other thing that came out. Like, I did a real estate panel, Matt, and it was anybody who's top tier in terms of real estate, they're fine. They're going to find their funding. Anybody who's B, C levels in terms of real estate work, it's going to be tougher for them.
Especially if you own the wrong kind of properties. If you have student housing, if you have medical offices, you're fine. But if you have retail stores, look at the big box stores in this building. This is prime New York City real estate, and we haven't refilled all of the empty storefronts in Midtown Manhattan since COVID.
Although we had on the panel, she oversees basically the old Sears properties and Kmart properties, and she said, we're so glad that people are stopped talking about the demise of the mall and have now focused on the concerns in the office property market, because she says the focus has shifted a little bit. But you're right, we still see a lot of vacancies.
I'm a huge fan of the mall. I love going to malls.
Why do you love the mall?
I just
have
like
you gone to
walk
the American
around, look at the stores. I haven't gone to the big ones yet, but I would if they were near me, right? I like water parks. I like indoor skiing. So I'm a big fan, and I think the kids should go back too. Remember hanging out at the food court when you were a teenager, buying ripped jeans and Doc Martens?
Listen, I live not too far from Paramus, which is the home of malls, and I remember when they got the first waterfall, and you would go to visit the waterfall. It's really embarrassing. All right, everybody, you are listening and watching Bloomberg Business Week. Carol Masser along with Matt Miller. Right now, let's head on over to World and National News. Off to Nancy Lyons. She's in our 99.1 newsroom in the nation's capital. Nancy, you like malls?
My first job was in a mall. So I have to say there is some love for a mall. Anyway, President Biden is trying something that appears to work in the European Union: hold airlines accountable for delays under their control. Bloomberg's Irv Chapman has details.
Some airlines offer hotel rooms and meals. Others simply give you back on request what you paid for the ticket. The president's proposal,
historic new rule, make it mandatory for all U.S. airlines to compensate you with meals, hotels, taxis, ride shares, and cash, miles, and or travel vouchers whenever they're the ones to blame for the cancellation or delay.
This spring, Transportation Secretary Buttigieg said the rate of flight cancellations was down to 2%. He's hiring more air traffic controllers and adding flight routes to try to reduce it further. In Washington, Irv Chapman, Bloomberg Radio.
Well, it is a big week for those watching the debt ceiling fight. President Biden will be meeting with House and Senate leaders tomorrow to see if they can find a breakthrough in their debt ceiling fight. Bloomberg Government's Emily Wilkins says it is an important meeting.
I'm going to be basically watching to see if Democrats are open to any sort of negotiations, because if they're not, I think that really sets off some alarm bells in D.C. and I would assume in the markets as well about whether or not we're going to be getting some sort of agreement.
Bloomberg Government's Emily Wilkins. Treasury Secretary Janet Yellen warned again yesterday failure to raise the debt ceiling would throw the nation into economic catastrophe. Charges have been filed against the driver whose vehicle plowed through a group of Venezuelans at a bus stop yesterday in Brownsville, Texas. 8 were killed, 7 others injured.
8 counts of manslaughter, 10 counts of aggravated assault with a deadly weapon.
That's Brownsville Police Chief Felix Salceda says the driver ran a red light and lost control. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We've got stocks trading mixed right now, with the Dow lower, the S&P little changed and higher. NASDAQ is also advancing. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Shaw. That's right. U.S. stocks mixed in a quiet tape, with the Dow currently down 53 points. S&P's higher by 2, and NASDAQ gains 15. The U.S. 10-year yield at 3.5%. Gold is up 5. Oil is climbing. And Bitcoin is sinking. That's down 5.4%. Of the main 11 S&P sectors, leaders were telecom and the financials. Real estate was under pressure, and leaders to the upside in the Dow, Disney and Walmart, while Walgreens fell 1.6% and led to the downside. Regarding those regional banks, PacWest was up as much as 30%, is now only up 3%. And after earnings, Tyson Foods plunged 17%. In other news, Apple kicked off its 5-part corporate bond sale, and Zscaler jumped 20% after raising its outlook. Wrapping things up, some of the names reporting after the bell tonight include PayPal and Palantir. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, into here live. Breaking news over your Bloomberg. Type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, under 18 minutes to go until we wrap up the Monday trading day. Let's get to it. Carol Master, along with Matt Miller, in our Bloomberg Interactive Broker studio on YouTube on Bloomberg Originals. And with us right now is Alex Coffey, Senior Trading Strategist at TD Ameritrade, joining us on Zoom from Chicago. Alex, good to have you here with Matt and myself. How are you, and what do you make of the day's trade and really the more broader market environment right now?
Yeah, thanks, Carol. Thanks for having me. It's been kind of a boring day, kind of like watching paint dry, but sometimes boring is okay. It's going to be a pretty busy week, I think, once we get CPI and PPI. Later on, of course, consumer sentiment as well. But all things considered, I think a fairly straightforward day on sort of a minimal news headline day. Certainly can change any notice, though.
What are you watching, or what are you seeing when you look at the regional banks? Is it all just trading action with not a lot of fundamental backing? Does it matter to the wider market?
I think it matters tremendously. I mean, I think it's right now it's almost a sentiment gauge, right? So we're seeing sort of the ebbs and flows of the uncertainty as it kind of picks up in both directions. And oftentimes it's sort of steering the market on the days where the banking fears really start to ramp up. Those have been the big red days. Fortunately, the last few, though, a lot of that fear started to dissipate as some of the worst of the contagion didn't ultimately materialize. But again, I mean, I don't see this as a story that's necessarily over. I see this as one that's constantly kind of, continue to transform and take us in different directions.
Hey, Alex, so what's kind of the retail trade on a name like PacWest, which was up 30% at its highs, and now is just up about 3%? That's quite a swing in one day.
Yeah, no doubt. And I think that this is a situation that's fairly typical for a stock that's plummeted as much as this one has. I mean, absence of negative news is going to lead to, somewhat of an optimistic trade, but the confidence
is the
in
retail
some of these
investor, though? Is the retail investor in on this one, Alex, or no?
Nothing that stuck out tremendously, but I would say that anytime something that's moving as much as some of these regional banks have, there's going to be interest, right? The volatility drives interest. But First Republic and some of the other names kind of working towards zero, ultimately going into receivership, going out, I think has scared some investors.
Are you watching the? We had the slews today, and then we had the. Well, we have coming up the Federal Reserve's
financial stability
report.
Yeah.
Sorry, everyone is watching it today, but no one has ever watched the Federal Reserve's financial stability report before. So, what do you think this tells us? That we're all following this so closely.
Nobody used to pull up the KRE either.
I never knew what slews was. I mean, I heard the senior loan officers survey, but yeah, is it making an impact?
I think it is, and I think the reason is everybody's trying to figure out, why is the market pricing in something for interest rate policy that seems so different than what we hear from the Federal Reserve? And we're looking for pieces to a puzzle to connect those two. Not to say that one is right or one is wrong, but right now, based off what the Fed has told us in words, the only way you can get to December lower rates, which is basically a certainty based off of the market pricing, is something substantially changing. Is that credit tightening? Is that more instability in the banks? Or is that a tremendous downturn in the economy? I don't know. I don't know if we're getting any of those things. But right now, to me, that's what the market has to be pricing in for that divergence to exist.
Hey, one of the reasons we love talking to you, Alex, is we do get a feel of what retail investors are buying or selling. And you just got your report in terms of what was going on in April. It's a backward-looking report, but give us an idea of where investors were buying, where they were selling.
Yeah, thanks. The IMX, the Investor Movement Index, did move up slightly, 3.72%. 3 straight months of net buying of equities. But some of the specific names that stuck out that I saw that were quite interesting is actually a move from the buy side. Of course, Tesla finds itself there. Obviously, stocks struggled a little bit in April, but Realty Income and Medical Properties Trust. So some REIT names getting some buying attention. Saw this as sort of contrarian. We've actually heard, obviously, some of the ramped up concerns around commercial real estate recently. Well, Realty Income, of course, specializing in single tenant retail, think 7-Eleven, think Walgreens. Some of those hybrid workforce environments that have disrupted commercial real estate, not really affecting that company. Of course, medical properties, more like hospitals. So I thought it was contrarian. I thought it was somewhat opportunistic by the client base. Especially given the context of the greater interest rate conversation that we were having.
I was looking at the breakdown of the S&P, and I thought at first it looked bullish because they're buying consumer discretionary and they're selling the staples. But then I see that commercial services and they're selling, I should say, the defensive. So utilities, industrials, healthcare, real estate, all getting sold off. Then I saw, though, that they're buying communication services, which is, I don't even know.
It's a terrible category.
It's a horrible category, but basically it's, the streamers. So Warner Brothers, Netflix, Disney, and then Google as well. Are these like defensive stocks these days?
Well, actually, it's funny, too, because they also throw in the telecom names there, too. And those were actually the ones that we saw with buying activity. So it's actually the Verizons and the AT&Ts that actually struggled quite a lot in April post-earnings for AT&T in particular. And then Tesla, of course, is consumer discretionary. That's a name that its pricing cuts have impacted its margins. It's gone down. But it's pretty consistently a name that we see in the top traded, be it buys or sells. I actually saw this month, in terms of the buying and selling, is kind of a contrarian action by the TD Ameritrade client base. Some of the ones that stuck out on the sell side, for example, Apple, Meta, Alphabet, Microsoft. All these names actually did really well in the month. In the case of Meta and Microsoft in particular, these are names that have done really well this year in general.
Yeah, it's interesting. Despite everybody saying it's time to get out of the growth names, we hear that over and over again, and yet that's where investors have been piling into. Yeah, final thoughts in terms of investors comfortable with this market, willing to take on some risk, or not necessarily? Or it kind of feels like that they are based on what you're telling me.
I would say cautiously optimistic would be my takeaway here. We're seeing a modest improvement, month over month for several straight months after the IMX bottomed out in November and December of last year, but it's still moderately low based on how we kind of section out in its percentile. So I would say cautiously optimistic, definitely some positive takeaways, but a long ways to go if we're going to get back to where we once were.
All right, we're going to leave it there. Hey, Alex, thanks so much. Alex Coffey, Senior Trading Strategist over at TD Ameritrade on Zoom from Chicago. You know, you talked about communication services. I'm looking at Disney. It's rallying more than 2% today. They got an upgrade over at, actually maintain overweight by Morgan
Stanley.
but raised their price target to 120 share. They report earnings later on this week.
Yeah, Disney doing well. Netflix is up 2.9%. Warner Brothers is up 4.6%. So big gains for the streamers today.
All right, you're listening and watching Bloomberg Business Week on Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. CEO Elon Musk is tweeting that Twitter will purge accounts that have not been active for several years, and this could lead to a drop in follower accounts since taking over Twitter in October. Musk has made changes at the social network to generate much-needed revenue and fulfill his pledge to make it a haven for free speech, while also battling spam and bots that degrade the user experience. Amazon.com is launching a new unit to distribute its movies and TV shows to other media outlets besides its Prime Video streaming service. Tyson food shares are plunging after the biggest American meat company cut its full-year sales forecast on what it describes as challenging market conditions. Tyson shares are now down by about 15.5%. Jen Bartushis follows packaged food and retail staples for Bloomberg Intelligence.
Well, with Tyson, it's really a combination of things. One, you've got some structural market issues in the protein market for both beef, pork, and chicken. and it's hitting Tyson all simultaneously. And then second, you have some execution issues that are Tyson-owned in terms of not running plants at full capacity and weak margins across the board. And so when you put all this together, it turned out to be a really weak quarter for the company.
Catalent shares are plunging at 25% following cuts to its annual financial outlook that hurt investor confidence in the contract drug manufacturer. After the bell, PayPal and Lucid. Those are some of the company stories we're following for you this hour. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. Carol Masser along with Matt Miller in for Tim, as you know. Just a few minutes, and we're going to head over to Scarlett and Romaine, count you down to the closing bell on this Monday. In the meantime, we've got a story that's among the most read on the Bloomberg. And Matt, you and I were talking about it in the break, and it's about student debt. And basically, it's about parents who've been helping out their kids, but they've got their own debt to worry about, too.
Yeah, and especially after...
college debt, that is.
Especially after they've had a few years moratorium, right? They hadn't had to pay their college debt for a while. Now they have to again, but a lot of the parents that are still paying, because a lot of these payment plans go out 30 years,
right.
They're starting to save up for, or they should be saving up for their own kids to go to college. And obviously those prices are absolutely soaring. So it's a great story, and one that I think a lot of people are going to be paying attention to.
Doesn't it freak you out? You've got a little one.
Yeah, so I have a 2.5-year-old daughter.
Right.
And I was worried about it for a while. Then I realized, since her mother comes from Spain and my daughter has Spanish citizenship, I can send her to school for free in Europe. European universities are very good, high quality education, maybe not as much partying. They don't have sororities. There won't be rush, you know.
Have you done like a broad sampling?
I've been over there many, many years.
Just checking.
So it's more focused on actually studying than U.S. universities. That part is kind of lame, but it's free, right? So I am telling my 2.5-year-old daughter, you're going to school in Europe, right? You can do a year abroad here in the U.S., but I'm not going to. My financial planner told me when I sat down with him last year, he said, if you want Edna to go to an Ivy League college, it's going to cost $1 million by the time she gets there.
It's crazy. And right now it's $70,000, $80,000 a year if you do housing. It's nuts. It's really nuts. The largest chunk of federal student loans, about over $600 billion. Belong to borrowers aged 35 to 49. So, like, yeah.
It's prime parenting age,
You're dealing
right?
with your own loans. Like, how can you help your kids?
Yeah, it's a problem that we need to figure out a way to deal with. I don't know what the answer is.
Go be a
I know that
plumber.
professors
Go be an
need to get paid.
electrician.
Yes, absolutely. Vocations
I'm
are
all
important.
in on that.
Apprenticeships are a big deal in Europe, and maybe we should be picking up where they left
My
off.
plumber was super wealthy, owned a ton of real estate, and then retired early.
My
was
contractor
like,
is
I'm out
loaded.
here.
Loaded.
All right, time to head over to Romaine and Scarlett. We're going to count you down to the close on this Monday. Countdown to the close beyond the bell starting right now.
It belongs to Communication Services. We're counting you down to the closing bell. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast with Carol Masser and Matt Miller. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and those folks streaming on YouTube. Carol Masser, not a whole lot rallying here on the day in the equity markets. There's a lot of activity going on, of course, in the bond markets, but you put it all together here, and this is a market still looking for direction.
Yeah, I'm calling it a meh kind of day, but yeah, you know, look into, it's a technical. But Matt and I were just talking about looking at some of the major industry groups in the S&P. Communication Services, which we've already decided, right, we've all talked about, it's a bad name for the group, but it's a lot of your streaming companies. You've got a Disney that's up about 2.6%, Matt, ahead of earnings this week.
Yeah, Disney is doing very well, and so are all of the streamers, right? Warner Brothers, I think, is up almost 5% right now, and you see a bunch of the other streaming services up 2, 3, 4%. So that's an area that's doing incredibly well as the telecoms. They flipped up and they were down earlier.
Yeah, but of course, it all comes down to the banks. We're just talking with Sarah Ketterer about how most of her clients are still worried about banking contagion. You look at the best performers, Zions, East West, Wells Fargo, but there are still a lot of banks banks under pressure, and KRE is down for the 5th time in 6 days.
It was interesting. We did get that senior loan officers survey a little bit earlier here. Certainly not the worst case scenario that people had been pricing in. We're going to get a financial stability report out of the Fed a little bit later today. I guess the big question is that if we're not sort of falling off the cliff, that doesn't necessarily mean things are healthy, and I think that's what the market has to parse here. As we get the closing bells here in New York, let's run through them real quickly before we get to some of the other breaking news. The Dow Jones Industrial Average going to finish the day lower by about 0.2% as we wait for these numbers to settle. Looks like the S&P 500 is going to hold on to a modest fractional gain on the day, but it's only up about a point right now as these numbers settle. That's basically just call it unchanged on the day. The NASDAQ Composite up about 0.2% here on the day, and the Russell 2000 closing out in the red, down 0.3%.
Yeah, and we talked about it kind of, at least on the major market averages, not much going on. If you dig a little bit deeper, the S&P, you've got about 289 names to the downside, 222 higher. Same thing with the NASDAQ, Scarlett. It's almost an even split in terms of what names gained and what names declined in today's trade.
That's true. Although having said that, when you look at the sector performances, the gainers have gained a lot more than the decliners have fallen. So you guys mentioned the streaming companies. They are certainly leading the way for media entertainment companies, up by 1.4%. All 5 members of the auto and components index are also higher. That's good for a 1% collective gain. On the downside, REITs are under pressure, as are software and services. Microsoft a big decliner, and capital goods companies too, off by 0.4%.
All right, so that's a look at your major industry groups. Let's drill a little bit deeper and take a look at some of the individual gainers. American Airlines among them, up about 3.6%, off its highs of 5.7% earlier in today's session. JP Morgan raising its rating on the stock to overweight from neutral, saying the company and peers Delta and United have wrestled the high ground from discounters. So definitely a standout performer in today's session. Six Flags Entertainment soaring, up almost 19% in today's session. First quarter results beat expectations. Analysts saying attendance was better than expected despite some severe weather in some key locations, and that total guest spending per capita was strong, so some strong numbers there. And then Zscaler, check this one out, folks. Pretty much holding on to its gains of the day, up about 20% here, surging, top of the NASDAQ 100, reported stronger than expected preliminary third quarter results, boosted its revenue, calculated billings, and adjusted operating income projections for the fiscal year. It's a cloud-based security software company, Matt, so some outperformance.
It's just,
there's
some of these companies where we know the name, but who has any idea what they do? Zscaler is a name I hear all the time.
It's almost $16 billion market cap.
I know it's a big company. I'm looking at Tyson Foods. We've been talking about the problems that they've been having all day long because the shares have dropped by so much, right? The biggest decline that we've seen since the financial crisis, as they see a challenging market ahead for all of their major markets, which are beef, pork, and chicken, 3 of my favorite markets. I'm also looking at KKR. We talk about the slowdown in M&A and the effect that it has on the big banks. Well, it has a big effect on the private equity companies themselves as well, right? KKR's earnings were down 26%. And as a result, the stock is off. And then Tupperware Brands has had so many problems, legal and reporting problems, financial issues.
It was a pandemic darling.
It was a pandemic darling, understandably so. And we have 2 whole cupboards of their products at our house. But if they fall any further, we can pool together our certs and buy the company ourselves. It's only worth like $30 million in total now.
Yeah, all right, let's take a quick check at the yield market right now. We did talk about what had been an interesting sell-off to start the day. That accelerated later in the day, actually pushing yields on the 2-year yield back up to that 4% level. And you see pretty much across the curve, we are elevated here as a repricing of the repricing continues. Some of that, of course, is based on economic conditions. Some of that was actually based on a big spike in yields that we saw a couple of hours ago when the Fed came out with its latest senior loan officers survey. And now another report hitting the wire right now. The financial stability report out of the Fed. Those numbers crossing the wire. Michael McKee standing by right now with what they said in that report. Mike, what did we learn out of this?
Well, it's kind of interesting. There are concerns out there, which is obvious given what's going on in the banking system, but the Fed is not overly worried at this point. The major concerns that they found in the financial system were real estate valuations, very elevated, they say, although there are a lot of reasons to think that these are going to be isolated issues and not going to be something that brings down a lot of banks, even though real estate loans have to be refinanced. Household debt to GDP, they say, is modest at this point, doesn't look like a problem. And while business debt to GDP is elevated, it is slowing. The overall quote from the Fed is that notwithstanding the banking stress in March, high levels of capital and moderate interest rate risk exposures mean that a large majority of banks are resilient to potential strains from higher interest rates. So the banking system doing pretty well. Market participants were asked what their biggest concerns are, and three things jump out: inflation, banking sector stress, and U.S.-China tensions. And what's really interesting, you look at that one, you look at commercial real estate, how much they've gone up in the past couple of months. The last report was in November of 2022. The only one that eased a little bit in terms of a concern was Russia's war on Ukraine. But all those things are just about 50%, not major problems on the horizon at the moment.
All right, Michael McKee, our Bloomberg International Economics and Policy correspondent there, with the latest readout here of what came out of the Financial Stability Report over at the Fed. We can get back to that discussion in a minute, guys, but just want to hit some earnings real quick. Skyworks earnings just crossing the wire a little while ago. Those shares down about 7% in after-hours trading here. We should point out that the revenue that they had for the current quarter actually pretty much came in lines with estimates, but here's your forecast. For fiscal third quarter revenue, going to come in at a range of about $1.05 to $1.09 billion. That's below consensus estimates. EPS for the quarter going to come in at about $1.67. That's below consensus estimates. Big part of the reason, guys, why you're seeing the shares down here in after-hours trading.
All right, going to go to Lucid, if I may. First quarter revenue coming out $149.4 million. That's a miss, folks. $197.8 is what the street was expecting. First quarter loss per share, 43 cents. That's about 3 cents better than what the street was expecting. The company coming out and saying liquidity is sufficient to fund the company at least into the second quarter.
We're in the second quarter.
It ended the quarter with about $4.1 billion total liquidity, but looking to make over 10,000 vehicles this year. So that stock down.
Please send money.
Down 4.8%. Yeah, that's not necessarily what you want to hear, right? On
no,
a quarterly
enough
update.
to fund the ongoing operations. For this quarter, they obviously need an injection from
a short timeline.
The Saudis.
Yeah, we need a little bit more of a time frame beyond this quarter. And interesting that both chip companies and, of course, auto companies did fairly well on a day like today. When it comes to the earnings season, Romaine, I feel like it really, we've seen companies beat lowered bars, certainly, but they have quite a bit of pricing power, and they're willing to sacrifice unit sales in order to get their sales. So they continue to raise prices because people will pay it.
Well, I think it was interesting, Western Digital also crossing the wire. The shares are down, but I thought it was interesting that their gross margin did actually tick up. And just real quickly, guys, just want to hit Palantir. Those shares up by 12% here in after-hours trading. A pretty big beat when it comes to both revenue and adjusted EPS, and the guidance that they're giving, at least the range that they're giving, appears to be well within the range of consensus estimates.
That's an AI play, isn't it?
I just want to make a quick correction, if I may. The headline, Lucid says liquidity is sufficient to fund the company at least into the second quarter. They meant the second quarter of 2024. So that's a little bit better than the second quarter that we're currently in.
That gives you a year, right?
They mean they have a year, which is pretty good. They also said they're going to make 10,000 vehicles, and they only sold 1,400 in the last quarter. So 10,000 would be a pretty big jump.
Can they sell 10,000 vehicles, Matt?
I don't know if they have.
They can make all they want. Are people buying? Those are expensive. I mean, I know, Matt, you're a car aficionado, but when I was looking at the prices, they don't have anything below 100, so they're clearly going for that premium market here, and I just wonder if there's enough appetite.
No, you're 100% correct. They only sold 61% of the vehicles they made last quarter, if that tells you something about demand, and they had to cut the price of that vehicle from $160,000 to $133,000. So, yeah, they can sell 10,000 vehicles, but they probably need to cut the price a lot further for a sedan.
Don't they all have to cut their prices in order to move it, ultimately?
Tesla raised prices on those vehicles. Tesla raised on the Model X and the Model S. So the high-end models are selling great for most companies, not so for Lucid.
You know what's doing really well? AI. Palantir saying it expects to be profitable every quarter this year and describe demand for its new artificial intelligence products as, quote, without precedent. So there you have it. And nothing, anybody?
No, that sounds about right. Well. I mean, it'll just reaffirm everyone's willingness to jump in on anything that has AI or ML in the description.
This is a tough crowd, man.
I'm
blaming you coming back, Matt here. Palantir's up 13-14% here in the aftermarket. So,
thank you.
And Devon Energy expanding its stock buyback program by 50% to $3 billion. So another headline crossing. All right, I guess we're going to go. That's a wrap.
See ya.
Our cross-platform coverage. See you later. Radio, TV, YouTube, and Bloomberg Originals. We will see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. Carol Masser along with Matt Miller live in our Bloomberg Interactive Broker Studio on YouTube on Bloomberg Originals. All right, let's get to it because we just got the Fed update on the financial stability of our system, specifically warning that banks' concerns about slower growth could lead them to make fewer loans, accelerating an economic downturn. That's our headline on our story by our Craig Torres. So let's get to it with our team. Bloomberg Intelligence Senior Analyst for U.S. Regional Banks, Herman Chan, back with us in our Interactive Brokers studio. On the phone in New York City, Chris Whalen, Institutional Risk Analyst at Whalen Global Advisors, someone who follows the financial sector, was with us during the crisis. Herman, I'm going to start with you.
During the great financial crisis.
During the GFC, exactly. Leaned on him in a big way. Herman, let's start with you. Among those two reports, the senior loan officers as well as the Fed's report, what's important? What's a takeaway for you?
Sure. So the senior loan officer survey was interesting because it showed that commercial loan demand basically has cratered to the levels of the great financial crisis, as you mentioned. So that's something that we weren't quite, we were expecting a pullback in demand, but not quite to the same level as the survey indicated. And it also showed that credit is tightening across the board, across all loan types. So commercial real estate, consumer. The banks are increasing spreads, being more cautious in terms of what loans they're putting on their balance sheet. And it just confirms the report just confirms what we expected heading into the report.
Chris Whalen, let me ask you, is this what the Fed wants anyway? I mean, don't they want tighter financial conditions? You know, if they hadn't wanted banks to fail, wouldn't they have done something more serious about it ahead of time? Or is this all part of the plan?
Well, I don't think the plan incorporates markets or banks in terms of the inputs. They're really focused on GDP modeling that the Fed met. And I've confirmed with some of my former colleagues, I worked at the Fed in New York, they don't talk to the bank supervisory people at all, astoundingly.
So one side is like firewalled off from the other, monetary policy and financial stability?
Yeah, and it's kind of concerning as far as I can see. But, you know, I think the answer is no, they didn't model this at all, and they really didn't know what the equivalent of open market intervention is in interest rate terms, you know what I'm saying? So they had to guess, and they went big thinking that was helpful, and in fact it was not helpful, as we can see. So, you know, there's this huge debate in the economics community right now about abundant reserves versus a more austere approach, and I think the austere approach is the right one. But we just have to fight our way through this, Matt.
Yeah, well, it looks like
it looks like repricing their balance sheets as fast as they can, but there's nothing they could do about assets.
Well, you know, this brings up an interesting point that Tom Keene was talking about this morning, and that is scale and the lack thereof, right? These banks are shrinking, and typically that's not great for investors in any company, in any industry, right? Is that just the reality of what's happening here on the KRE? Do we have to look for all these regional banks to shrink?
Well, you have to look for the system to shrink, because as the Fed shrinks its balance sheet, every time a Treasury bond is redeemed on the books of the Fed, a deposit disappears because the Treasury is in deficit. So they have to refinance that bond immediately. Your customer buys the bond, the deposit disappears, right? So the mechanics of this are very Darwinian, very, you know, binary, one-to-one. And at the same time, you see the banks are very competitive. Even the big guys, they're out there for 4.5%, 5% now for 1 year. And it tells you they have to compete for money with the little guys. You know, it's the banks versus the Treasury, and the Treasury is at, what, 5.20 this morning on 1 month?
Right.
So, you know, that's the problem. People come to me and say, Chris, if the Fed doesn't do any more, is it okay? And the answer is no. They've already done too much. You know, they could have maybe gotten Fed funds at 3.5 or 4 without breaking the China, but I think we're going to break some China. I really do.
Chris, you hear? Herman Chan, Bloomberg Intelligence regional banks analyst. Are you hearing the same thing from the banks themselves? Are they at all pointing the finger at the Fed?
Well, they're not going to point the finger at the Fed because, as we talked about earlier here, the Fed is also the regulator. So
yeah, but they don't do anything. Who cares if they're your regulator? They could be my regulator. I never heard from them. You know?
Right. Really, the Fed creates the rules of the game, and the bank management team have to abide by those rules. So you abide by credit rules, you abide by interest rate rules, and if you don't, then you have a chance to break your bank, and that's really what's happened over the past couple months.
But it's just the velocity of change. The time is so inadequate for these banks to actually adjust. You You know what I mean?
Yeah.
They roll off at maybe 20% a year, if you think of it that way. So they can reprice 20% of assets a year. Now the deposits are headed for 5 right now, this quarter. So that's going to be a remarkable shock, I think, for earnings and for net interest income for the whole industry. You know, if you look at our blog, we model it down $30 billion. And they'll still make money, don't get me wrong, but the surge in cost for funding is going to be remarkable, I think.
So, Chris, what's the regional bank industry look like on the other side of this?
Smaller.
Well, but because it's interesting, coming off of Milken, and I was talking about this with Matt earlier, is that I'm just blown away by the role of the private market in so much, especially when it comes to smaller companies, mid-sized companies. So I just wonder, the big guys have been like pulling back for a long time. Regional banks, maybe not so much. So what happens to our financial system more broadly if we don't have those regional banks out there?
Well, you'll have more non-bank involvement facing consumers because big banks don't want to face consumers. Think of the credit scale for FICO scores. Most big banks don't want to talk to anybody in the bottom half. It's just too much risk and too little reward. So particularly things like mortgages, they don't care. And that means that, the community banks, who are the ones who actually provide credit to communities at the micro level, and particularly vulnerable communities that are not well served, FHA lending, for example, that will go even more to non-banks. And the irony, of course, is that the federal government, the home loan banks, for example, don't deal with non-banks. So 3/4 of the industry is not supported.
Right.
This tighter credit is precisely what the Fed wants to do to slow down inflation,
they're
right?
going to get it, because to your earlier point, they are stepping back, and it's not just this loan officer survey, right? It's the treasurer walking into your office, you're the CFO, and he says, I want to double cash by the end of the quarter.
That makes sense.
Look at everybody tapping the debt markets, right?
Yeah, but the easiest way to raise cash is stop lending. As the redemptions come in, you just don't redeploy them.
I mean, for me, the ramifications seem like they could be amazing. Everyone's tightening credit as the price of money goes higher. Meanwhile, on the good side, we've been trying to make as much stuff as we can. We're going to end up with big fat inventories at the end of the year, I hope, in the form of much cheaper V8 engines for me. Because I talked to dealerships lately, and they say the same thing that you do, Chris, about people on the lower end of the FICOs. They don't even want to hear about it. And they used to ask, do you have a job? Now they want to know what job it is and how much you get paid and how long you've worked there. So they really care.
Well, they care, and also they know if they don't have more stringent standards, they can't sell the loan.
Right.
These loans are mostly originated for sale to investors. So, and a bank is even worse. The bank doesn't want to see a loan that's not the middle of the fairway. So that, you know what I mean? The banks are even more picky than the cash investor.
Which just means those who have been squeezed out of the financial system, locked out of the financial system, it's just even worse for them, ultimately.
You've seen some of the growth.
The Fed approves mergers, usually for wounded banks. Never forget Chase was bought by J.P. Morgan because it was gutted by Penn Square.
Right. Say 5 seconds for you, Herman.
I was just saying this. You've seen some of the growth in some of the non-banks, the AI type banks like SoFi and
got it, run.
You got it.
Herman, Chris, thank you.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. Earnings fast and furious after the close of trading, and we've got you covered. Palantir Technologies says it expects to be profitable every quarter this year, and it's describing demand for its new artificial intelligence products as, quote, without precedent. The stock surging after hours. Palantir now up by about 28%. Lucid Group has guided toward the low end of its annual production plan following a slow start to the year. It is the latest setback for an EV maker that is grappling with job losses and supply chain snags. After hours, Lucid Group down by roughly 9%. And PayPal has boosted its forecast for full-year profit after spending on its platforms jumped more than expected in the first 3 months of the year. After hours, PayPal is down by 2%. Turned out to be a mixed day today, with the S&P eking out a small gain. Treasuries fell as investors weighed what it would take to finally reverse the Fed's stance on rates after a survey of loan demand showed signs of credit tightening. S&P up by 1 point today, a gain of less than 0.1%. The Dow down 55, drop there of 0.2%. NASDAQ up 21, that is a gain of 0.2%. 10-year yield 3.51% with a 2-year, 4.00%. Spot gold up $3 the ounce to 2020, a gain of 0.2%. West Texas Intermediate crude up 2%, 72.79 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Matt Miller live in our Bloomberg Interactive Broker studio on YouTube and Bloomberg Originals. Well, 1 week ago, a group of us were out on the West Coast at the Milken Institute Global Conference. It's really a who's who in the world of investing and finance and markets, both public and private markets, and a lot more. And our Bloomberg New Economy editorial director, Eric Schatzker, was there. He wrote about it over the weekend. He joins us, Matt and myself, in studio. How are you?
I am well.
So,
by the way, we were talking about our old morning show.
Oh my goodness!
You, me, and Julie Hyman
the
were
one,
like
the one where
to Carol Massar.
The one where, if I recall correctly, Matt looked straight at the camera and said, "Good morning. It's 6:30 here in New York City. I'm Carol Massar."
I did that one time.
It
One
happens.
time. It was 20 years ago.
But you know, it was legendary, Matt.
You can trust the man to read the teleprompter.
It's exactly. All right, so talk to us. First of all, what'd you make of Milken this year?
Oh, I thought it wasn't nearly as dour, somber as I thought it might be.
Yeah.
You know, given what happened in financial markets last year, that's one good reason to wonder why. However, I think the answer to that is so many of the people whom Mike Milken is able to draw to the global conference are in private markets. They're in private equity, they're in private credit. And whether it's because those assets have held up better or whether it's because they don't face the same pressure to mark them to market, they don't feel nearly as bad about the state of the world as those who do have to participate in the public market.
We did see KKR come out with a 26% drop in earnings. So some of them have done not well, right? I mean, relative to others.
Some of that has to do with the way that...
Slowdown in M&A and...
Oh, sure.
Yeah.
If you're an investment banker, yeah, now is not... It's not a bull market for M&A. And if you're a diversified private asset manager like KKR and you earn a lot of your distributable income on the basis of performance, you know, now is not as good a time as 2022 was, as 2021 was, for sure.
Yeah, I was blown away again. Another year where it's like all about private markets, almost every conversation. Having said that, you know, there were other things like globalization and China came up a lot, and that's something you were focused on.
Absolutely. I went to Milken wondering how deeply and carefully participants there would be thinking about China. And honestly, I was surprised. Everyone whom I spoke to and everybody whom I heard talk about China has clearly given the questions that America's relationship with China, Europe's relationship with China raises much more careful thought. In fact, they've walked through the sort of situational analysis in a very deep way, and they come at it from very different perspectives. You would expect someone like Karen Carniel-Tambor, who's one of the newly minted chief investment officers at Bridgewater, to be thinking about this. But for example, a guy like Mark Newman, who runs a chemical company called Chemours, which was a spin-off about a decade ago from DuPont, has also given this extremely deep thought. And his company is, unlike most in the industrial world, not that highly dependent on China. It relies on China for some important ingredients in its refrigerants business. You know, a lot of what they do has to do with fluorine chemicals, and they're used to a large degree for refrigeration. But they're also in a whole bunch of other stuff, and China isn't a hugely important part of the supply chain, and it also isn't an important part of their revenue stream, less than 10%, and yet he and I could spend an hour talking about it.
Which is interesting, right? That it's still a topic.
Haven't investors been burned just one too many times by China? I mean, especially when we saw what happened to Chinese companies listed here, or when we saw what happened to Alibaba. You know, when they disappear the CEO, or when they disappear the investment bankers that work on deals, I guess you could say, fool me once, shame on you, but you're not going to go back for a second time, are you?
I'm not the right guy to ask.
Did people at Milken say, we've been fooled too many times by China? Well, we're not going to go back.
To be fair, that's a question I could have asked, but it isn't the question I was asking. What I was trying to find out is, how are investors, CEOs, operators of individual companies processing the implications of the geopolitical tension that exists now, the questions that raises about this big energy transition that the world evidently is trying to achieve, and what it means, or how they're thinking about the reshoring or onshoring of production that also appears to be underway, and which has led America and Europe to pass several bills to try and sponsor homegrown manufacture of semiconductors and clean energy products.
I love, we did too, David Hunt over at Peach, the CEO, and what he had to say. He had this great kind of big macro perspective. Share with us, because I thought it was brilliant.
Well, his point was that the first phase of global, what China's great export to the rest of the world was disinflation.
Right.
That's what we achieved by sending, over the past 25 years, so much of the low complexity and high labor cost manufacturing that this country and Western Europe used to have. And now, as we try to bring that back, what are the implications? Well, one is that the supply chains we're going to have in the future might be more resilient than this, highly globalized but very fragile supply chain that existed and whose frailty, we discovered during COVID. But the other implication, of course, is that it's going to cost a lot more. Things cost more money to make here, for the most part, or in Western Europe. That really just appears to be the fact of the matter.
But it is a story of coming back, though. It is a story of bringing our investments that we made in China out and back to here or to our allies. It's a story of leaving China. It's a story of no longer trusting the supply chain there. Not to say
there are two ways of looking at it. On the one, you could, decoupling is a narrative, but the other version of that narrative is China plus one. In other words, you continue to source from and to a large degree rely on China, but you build redundancies into your supply chain, so you aren't wholly dependent on a single country for your raw materials or components or manufactured goods. You can go to another place. And the point that Hugh Van Steenis, whom you may remember years ago from Morgan Stanley, made, and he's now with Oliver Wyman, is that the geopolitical environment we occupy is changing or influencing these conversations in what he described as profound ways. Countries, not just companies, are beginning to think of things like China plus one in ways that they never would have imagined. For example, Europe is starting to look to North Africa as a source of energy and potentially energy equipment like solar panels. That was unheard of 25 years ago. They never would have looked to Morocco and Algeria and Egypt and Namibia as a source for these things. And now because of the uncertain future for not just America's, but Europe's relationship with China. That's something they're considering. And of course, the fact that they've been cut off from Russian gas, that's an important part of the equation too.
That's the thing people were saying to me. Globalization isn't done or dead. It's just being reworked. And
I call it reglobalization.
Yeah, and that it's not going away, but it's going to be different supply chains and different alliances, and that's what you're going to see. And that's exactly, you wouldn't have thought about this 20 years ago.
No, what people did for the past 25 years, what's outsourced was build supply chains that were optimized for speed and cost.
Right.
And the supply chains of the future will be optimized for security.
Which goes back to what Bill Gross said, right? This whole idea of getting back to 2% kind of makes no sense. And that was mirrored too at Milken, where people said, we're not going to get back to 2% because of these changes.
Yeah, I spoke with Bill Gross this morning or this afternoon, and he definitely doesn't think we're getting back to 2%. He said we may dip down to, say, 3, but then we're going to bounce back up to 4, and it's going to be a problem.
There are at least two things going on there. The one is the stickiness of inflation and the fact, as we've been discussing throughout the Bloomberg newsroom, companies prioritizing price over volume.
Yeah.
That's one thing. They feel like they have pricing power, and they continue to use it. And then the other, of course, are these supply chain implications.
Well, great stuff and great perspective. This is why it's fun to go to some like Milken. All right, Eric Schatzker, our Bloomberg New Economy editorial director. Off to D.C., Nancy Lyons with World and National News. Hey, Nance.
Thanks, Carol. President Biden says his administration is proposing a new rule that would require airlines to compensate passengers when flight plans change drastically due to causes within the carrier's control. This means covering things beyond just a refund in the ticket price.
That will make it mandatory, not voluntary, but mandatory for all U.S. airlines to compensate you with meals, hotels, taxis, ride shares, or rebooking fees, and cash, miles, and/or travel vouchers whenever they're the ones to blame for the cancellation or delay.
Biden says the European Union has a similar program after it was implemented. He says the number of flight delays went down. His administration is also launching a new website, flightrights.gov, where you can see what airlines will provide in the way of compensation. Border communities continue to prepare for Thursday's projected end of Title 42, the Trump-era immigration policy that allowed Border Patrol officials to deport migrants due to public health concerns during the pandemic. Arizona Governor Katie Hobbs, a Democrat, says she's concerned about the expected influx of as many as 10,000 migrants a day.
Now, with Title 42 set to expire, I'm afraid these challenges will only get worse. And I'm afraid the federal government is unprepared to meet the demands of the expected influx.
Governor Hobbs says she's pressing the Biden administration to provide more resources. Closing arguments just wrapped up in the New York civil assault and defamation trial against former President Trump. Author E. Jean Carroll alleges Trump sexually assaulted her in a Bergdorf Goodman dressing room in the 1990s. Trump has denied any wrongdoing. Jurors will begin deliberations tomorrow. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We check markets all day long here at Bloomberg. After hours, PayPal shares, they are moving lower, down now by about 3.9%. PayPal did boost its forecast for full-year profit after spending on its platforms jumped more than expected in the first 3 months of the year. Lucid Group guided toward the low end of its annual production plan following a slow start to the year, the latest setback for an EV maker that is grappling with job losses and supply chain snags. Shares of Lucid down after hours by roughly 8%. The data analysis company Palantir Technologies says it expects to be profitable every quarter this year and described demand for its new artificial intelligence products as, quote, without precedent. After hours, the stock is up now by about 26%. Equities eked out a small gain today. Treasuries fell as investors weighed what it would take to finally reverse the Fed's path on rates after a survey of loan demand showed signs of credit tightening. The S&P 500 index little changed, up by less than 2 points. Alex Coffey is senior trading strategist at TD Ameritrade, and right here on Bloomberg Business Week, he told us this was, all in all, a pretty boring session.
Sometimes boring is okay. It's going to be a pretty busy week, I think, once we get CPI and PPI. Later on, of course, consumer sentiment as well. But all things considered, I think a fairly straightforward day on sort of a minimal news headline day. Certainly can change at any notice, though.
Dow Industrials down 55 points today, drop there of 0.2%. NASDAQ up 21, a gain of 0.2. 10-year yield 3.50%. The 2-year 3.99%. Spot gold up $4 the ounce to 2021, up 0.2%. And West Texas Intermediate crude rallied 2% today. WTI 72.77 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matt Miller. Are you a chocolate or strawberry frosty kind of guy?
Chocolate. This is an odd question because when I was a kid, there was only one kind of Frosty, right?
Meaning what?
I didn't know if it was any specific flavor. It was just a Frosty. So now when I go to Wendy's and I ask for a Frosty, they ask me what flavor. I'm like, come on, there's only one flavor, but apparently you can get multiple flavors.
You could get the flavor you don't want. All right, we are, of course, talking about Wendy's. They do report earnings on Wednesday before the open. Something they've been doing, and really other companies generally have been incorporating for years into their strategy and how they make financial decisions is ESG. We're talking about environmental, social, and governance issues, which we know is going through its own little reckoning. Weighing in, though, on that for us this afternoon is Liliana Esposito, Chief Corporate Affairs and Sustainability Officer over at Wendy's, joining us on Zoom from Dublin, Ohio. Liliana, good to have you here with Matt and myself. We do want to talk about ESG. You've worked, though, in the food industry for a long time. You've worked at Dean Foods, Mars. What's top of mind of you when you think about ESG and what needs to be done?
Yeah, great to be with both of you. And I will say, Matt, if you haven't tried a strawberry frosty yet, they just came back to our restaurants and you're missing out. So definitely give that one a try. And look, I think that even the letters ESG are relatively new in terms of this area, but obviously companies, Wendy's and others have been operating responsibly for decades. But I think what has changed is really the demands that those efforts really be formalized and that they be very goal-based. And so, at Wendy's, we organize our ESG portfolio under the platform of Good Done Right. And we've got some I think, pretty aggressive public-facing commitments around food, people, and footprint and what we're trying to accomplish that we would essentially say is doing our fair share or more than our fair share to really demonstrate that we are operating our business in a responsible fashion.
It seems to be a difficult business. I mean, like if you want to do ESG, you don't want to be working at an oil producer or a hamburger seller because, that's one of the leading causes of climate change is raising beef. So how can you change that?
Yeah, it's got to be a partnership, and so what you're referring to clearly are around greenhouse gas emissions. You know, we have set a science-based target for greenhouse gas emissions reductions, and that will include scope 1, 2, and 3. So scope 1 and 2 are the about 400 restaurants that the company owns and operates ourselves, and then scope 3 is our franchise restaurants, which generally look and operate like a company restaurant. They're just owned by a franchisee, but the biggest part of our footprint is our greenhouse gas emissions footprint is our supply chain. And the biggest part of that is proteins and specifically beef. And so, you know, the encouragement is that, you know, many of our suppliers have already started down this path, even in advance of us, of setting their own science-based targets. But we know that we'll have to work together. It's not going to be just Wendy's changing that landscape, but substantially improving the footprint, the environmental footprint of agricultural production, and with a heavy focus on protein is definitely going to be necessary to achieve these targets.
Liliana, what about garbage? And I think about food waste in particular. So, plastic. I mean, it's
Oh, food waste or plastic?
Food waste in particular that ends up in dumps, and the methane that's produced off of that, and other, which is more problematic.
The food waste goes into your compost. Do you not compost?
Matt, no. People throw out a lot of stuff, and it ends up in the dump. Matt's apparently raising
Liliana, do you
chickens,
compost at Wendy's?
I do at home. I actually am fortunate to live in a community that has curbside food waste pickup, but that is unusual, and that's a really key piece. Is that I will say for Wendy's restaurants, we actually waste very little, and I think that's not unusual for a company of our type because it's just a small footprint. And so, you know, our operators get very good and have gotten very good over the years of only ordering what we're going to prepare and only preparing what we're going to be able to serve. And
really,
so
you guys are that tight, so you're not throwing out a lot of stuff.
And we've actually done some audits on that and have found that, but there's always opportunities to, you know, to be better. But certainly as you look at the supply chain, that's where a lot of that waste may be occurring, particularly in agricultural products. And so it absolutely is it's absolutely a focus for us. It's interesting, and you mentioned plastics, and maybe we'll get to packaging as well. One of the things we're doing right now in some of our Chicago area restaurants is we've actually got some initially 2-stream trash receptacles, so, you know, landfill and recycling, and over time we may add composting to it. We did kind of a video study essentially of the waste produced by the restaurant, then did some education with our team members as well as with customers, showing them what of our packaging in particular, and then for our team members, what of our back of house packaging could be recycled. And then on the back end of the pilot, we'll look at that same kind of video technology and see whether we were actually able to change behaviors.
Don't we need to get rid of plastic though?
Well, straws. What do you do about straws?
Well, haven't you gotten rid of straws already?
No, we still have straws, and I will say, you know, one of the commitments that we've made is that by 2026, 100% of our customer-facing packaging will be sustainably sourced, and so we're defining that as either recyclable, compostable, or reusable. And so we just put out our corporate responsibility report a couple of weeks ago, and reported that we're now more than halfway towards that goal. A big part of that progress over the last year for us was actually transitioning our beverage cups from our former kind of paper-based cups that had limited recyclability into a plastic format that is recyclable. And then we're also incorporating post-consumer recycled content into those cups. We'll do that over time. And so, you know, one piece of the puzzle is the material, making sure that you have a material that is recyclable or compostable. But then also making sure that you have the infrastructure. And we certainly don't control that, you know, at Wendy's, but certainly that's a great need of ensuring that there is infrastructure to be able to recycle or compost these materials when they're made available. And then the third piece is educating the consumer so that they know what to do, you know, with the packages that they have.
So full disclosure, I'm from Columbus, right? So I love Wendy's with all my heart. I mean, I used to go and eat at store number 1 on Broad Street with my grandmother growing up.
Fantastic.
So I have a very special connection, but you definitely don't want to be giving out straws, do you? Isn't that the worst kind of possible CSR sin, ESG sin, straws?
I don't think I'd agree with that. And really, I mean, in the grand scheme of total packaging, you know, certainly items like cups and wrappers and containers produce more product. Challenge with straws, and it's not unique to straws, but they're small, and so even if the material is technically recyclable, most facilities won't accept that. And so we've got some locations that have alternatives to plastic straws, and certainly are looking at other alternatives as well. But a lot of consumers, really prefer to have a lid. And
I don't know. I walk around with a metal straw. I got my own little reusable, wash them. That's what we do. Liliana, thank you so much. Liliana Esposito, Chief Corporate Affairs and Sustainability Officer at Wendy's on Zoom from Dublin, Ohio. Chocolate Frosties for Matt, though. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Data analysis company Palantir Technologies expects to be profitable every quarter this year, and it describes demand for its new artificial intelligence products as without precedent. Shares after hours up by 23%. Lucid Group has guided toward the low end of its annual production plan following a slow start to the year. It is the latest setback for an EV maker that is grappling with job losses and supply chain snags. We've got Lucid after hours down now by roughly 9%. PayPal Holdings is boosting its forecast for full-year profits after spending on its platforms jumped more than expected in the first 3 months of the year, down after hours by about 3.6%. Dish Network is reporting results that trailed Wall Street's estimates for virtually every major earnings metric. And with more on the story, here's Bloomberg's Steve Rappaport.
Charlie, it shows the added challenges of a cyber attack on an already difficult consumer market for satellite TV and wireless service. The company lost a total of 552,000 pay TV subscribers, including satellite and Sling customers. Analysts had anticipated a loss of 390,500 TV customers. Dish has been trading at a multi-decade low, falling about 50% this year. The company has struggled with funding pressures due to an expensive wireless network build-out and a crippled customer service and bill-paying system that was disrupted by a computer system hack in February. Charlie?
And that's Steve Rappaport reporting. Dish shares up today by 2.1%. Those are our top company stories, and this is Bloomberg.
All right, let's get a quick check on the latest world and national news.
This is Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
All right, now let's get a quick check on the world and national news with Nancy Lyons. She's in the Bloomberg 99.1 newsroom in Washington, D.C.
Thanks, Matt. It is unclear who will blink in the debt ceiling battle. President Biden has invited top House and Senate leaders to the White House for a meeting tomorrow. And Bloomberg government's Emily Wilkins says Democrats are looking to Biden to lead them out of this impasse.
That is who I think Democratic leaders in Congress, Chuck Schumer and Hakeem Jeffries, are really looking to as far as how Democrats want to move, whether or not they want to engage in negotiations with Republicans or whether they just want to say, hey, look, the only thing we'll accept is a clean debt limit.
Bloomberg government's Emily Wilkins says 43 Republican senators have signed on to a letter that says they will refuse to consider any debt limit bill that does not include spending cuts. The Biden administration wants to put new rules in place that would require airlines to provide meals, hotels, and additional compensation to travelers on canceled or severely delayed flights. President Biden says they're launching a new website as well, flightrights.gov.
If it's the airline's fault and your flight was canceled or delayed, you can check the dashboard to see how the airline should be compensating you, like rebooking a flight or accommodating your hotel room and your meals.
Biden says there just needs to be more transparency. We're learning more about yesterday's incident in Brownsville, Texas, in which an SUV plowed through a group of migrants at a bus stop. 8 people were killed. Police Chief Felix Salceda says a 34-year-old local man has been charged with manslaughter.
The driver of the vehicle, later identified as George Alvarez, November 9th, 1988, had attempted to flee the scene after